Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus, hosting your host. Always pleased to be with you. Thank you so much for tuning in. We have, alongside my co-host, Brian London, we have Jon Deane, a man from Down Under. He is the CEO of Infinigold, which is the technology partner to the Perth Mint, and they have digitized the gold reserves via the Gold Pass app and Perth Mint gold token. So we're eager to talk about what digitization means for gold ownership. So welcome, Jon. I'm excited to investigate this topic.
Yeah, thanks for having me, guys.
And well, actually, before Brian was saying, just why is it an interesting time just to own gold in general? Why is it, as you recently wrote, so in vogue?
Listen, I think gold has come back in vogue, right? The last really 10 to 20 years, we've seen a large shift in the ways that the amount of debt sitting on society. We've really had since 1991, the dot-com crash in obviously 2000, then the 2008, then 2012, sovereign crisis, and then more recently, obviously, the COVID pandemic has all been events which is really around, putting leverage into the system, that leverage being taken out by governments and going to government balance sheets with the concept that would move that back into the private sector with time. But generally what happens is the cycle reverses itself. We keep that debt on the government balance sheets and never really move it off. So we're just continually building this society of, I think, devaluing fiat currencies versus hard assets. Has taken some time, but I think the COVID-19 pandemic has really sort of accelerated what was already building to be quite a big gold market. And on the back of what we've seen from the stimulus in the last, really, I guess it's 6 months, $12 trillion really globally. Gold has become at the forefront of a lot of investors' portfolios, both in the institutional space, but also in the retail space. And there's a lot of, confidence now around gold moving higher, which also gives a little bit of concern in most markets when, everyone sort of thinks it's a one-way trade. But, I think generally speaking, over the next 5 to 10 years, gold as an asset will outperform a number of other assets if we continue down this track of really devaluing fiat currencies versus hard assets.
I think, Fergus, I think Jon has just put it perfectly. Jon, you just said what I've been saying for some time, but with a much better accent. It's just really, you're absolutely right. The one concern I have, and it's a great point that you made, is that it's become such a consensus. So that naturally kind of raises the hairs in the back of your neck if you're contrarian, that everybody agrees with it. But then again, it's hard to argue that up is up and down is down at some point. And it's obvious that sovereign debts now are at such levels that we're going to have depreciation of the underlying currencies over time. And as long as you have that big picture and you're looking at the horizon and you keep that in mind, it doesn't really matter what happens in the interim and how these short-term sentiment flows back and forth in these markets. The bottom line is that the importance of gold in a portfolio is growing with time and is going to become absolutely necessary over time. So it sounds like you have a good handle on that, and you're actually creating products to address that.
Yeah, I think also, we're seeing popularity of MMT sort of build as well. MMT, in my opinion, is really just going to create further demand for assets like gold and potentially other form of hard assets, whether that's real estate, agricultural land, potentially things like Bitcoin. I think a lot of these sort of changing dynamics will put gold well and truly back as a core part of people's portfolios. Another thing which really hasn't been addressed, and I'm not sure if you two both look at this, but the 60-40 portfolio and whether that could be coming to a bit of an end, considering we're at close to zero rates around the world, and whether the correlation between bonds and equities is potentially breaking down. So, that negative correlation, I should say, between the portfolio. And in that environment, where do you transition your risk assets to, right? How do you get that negative sort of correlation back into your portfolio and whether gold forms part of that, coupled with obviously, what we were talking before around, the devaluation of fiat currency.
That's a good point too, John. I was just talking about that in someone else's podcast earlier today and in some other forum in recent days, that all of modern portfolio theory is built on backtesting different asset mixes to try and achieve that efficient frontier, the highest risk-adjusted return. And yet, since really the 2000s, and particularly since 2008, all correlations are going toward one in all these asset classes because everything's being driven by central bank liquidity. So over time, these portfolio mixes, as they look backward, are going to see these correlations or contracyclical correlations kind of collapse. So what is that going to say about portfolio mixes? And in fact, the most efficient returns dictated by modern portfolio theory are actually going to be the riskiest returns and are going to combine more and more of these inflated asset classes. The only thing that's been kind of contracyclical or anti-correlated in recent years has been gold from 2011 to 2015. Other than that, everything's just really been driven higher and higher by central bank monetary policies.
Yeah, that's spot on. So, I think there's a couple of questions here. One is whether, the bond bull market's coming to an end. And, that's something which people have talked about for quite some time, since 1980. Looking at back testing, everyone's really looking at, from 1980 to today, and then using the great bond bull market as really your, data set to calibrate your portfolio going forward. So if that bond bull market is coming to an end, what does it mean for a portfolio composition going forward? Should you be allocating to commodities like gold, as obviously as a hard asset, as a, a preserver of wealth, I think is one question. I think we're already starting to see it. I know down here in Australia, and obviously we have one of the biggest superannuation businesses in the world. I think we've got third largest in relation to assets under management. We're already seeing a number of equity portfolio managers starting to allocate to assets, like i.e. starting to allocate to gold. Very, very small percentages, but these portfolio managers have never, ever held gold in their portfolio. Like, they're really mandated only to hold equity. Now they're saying, well, arguing gold is cash, they can put gold into their portfolio as a really defensive way to protect their underlying risk. And, they're the types of new market participants that the gold market really hasn't seen since the 70s. And so as that market composition changes, as we start to see more and more, I think, of the institutional space come in and allocate to gold, that's when we start to see the bigger move higher. I think the last really $300, $400 has been probably people who know gold, understand it, the macro community, where the macro trade is coming back on the back of a lot of, obviously the stimulus you mentioned before, but that new market composition, new market participants, they're the drivers. They're the ones, I think, that take it dramatically higher.
Okay, do you want to address then the different forms of gold ownership? Because recently, man, his name escapes me right now, Brian, but we had one of your main, Dennis Gartman, main men on to discuss why he was basically dropping his gold holdings or taking a breather, and he mentioned that he just bought the GLD, just the is that a gold ETF, I assume, Brian? Yeah. Now, there's a great deal of concern among many people that these paper ETF holdings are simply not backed, right? That they're not, at least not 100% backed. How much credence do you give to that concern?
I don't think it's a really valid concern, to be honest with you. I think a lot of those GLDs, ETFs are 100% backed. The issue with all of those products is there's what I call a financial middle layer. So we have effectively financial institutions that are structuring products, whether it's an ETF or a trust, to create market access to the precious metal sector. So realistically, a product like an ETF, a future, is really what I would say a structured product. It's a financial middle layer which adds cost to an investor getting access to the underlying product. So GLD, it charges 40 basis points per annum to carry that asset. What we do, and obviously at Infinigold, is we license technology to the commodity sector. So in essence, we're taking the commodity producer and allowing them to sell either directly, B2C, to the market, right? So i.e. take that product directly to market and sell it, really disintermediating that financial middle layer, allowing people to buy the underlying asset and own it. Obviously, they would stream a 24/7 price for the asset as well, or vice versa, allowing them to stream it B2B. B2B is via other forms of digital distributors. So other digital distributors that have other market access, it gives them the ability to sell directly into the investor spectrum.
And so, yeah, your claim is basically this is just the digitization is a more cost-effective approach than even the ETF option. Now, how much secondary market activity is there for digital gold at this point?
So it's really about reattributing value back to the people who own the underlying asset, who are originating that underlying asset. So what I was saying before is, with the ETF market is really turning a commodity into a security and then using existing rails for investors to access that product in the securities market, right? Whether it's your banking lines, your lending lines, whatever, right? You can get into the market in the same way that you access traditional equities. What we do with Infinigold is we're providing access, but taking out that middle layer. We can still get into a securities market, but we're really saying you don't need the wrapper, right? That additional cost to get in. So coming back to your question around, how much secondary trading is there in this space? Well, the Perth Mint is owned by the West Australian government. They're the largest gold refiner in the world. They export 10% of the world's refined product, and they stream a price of gold 24 hours, 7 days a week via our app. So, for instance, really my size is your size with the Perth Mint. It's their pricing. It's nothing to do with us. We're just licensing the technology to them. You could access interbank liquidity directly with them. You can trade in as small a size you want to do. Obviously, our technology is infinitely fractionable, so you can trade, 1 cent, 2 cent, 3 cents worth of gold, or you can trade, $200, $300, $400, $500 million in a transaction. That price is there 24/7, so it's not really an issue of liquidity.
Is it backed by gold in the Perth Mint's vaults?
So it depends. So there's multiple different types of products. If you want to trade in scale, then it's unallocated gold. Unallocated gold with the Perth Mint comes with a government guarantee. So the West Australian government provides a guarantee on all Perth Mint holdings, and it's obviously audited on a daily basis.
Yeah, the Perth Mint has really been on the forefront for years in offering new ways to own gold, certificated gold, et cetera, to investors around the world. And it has built a reputation for doing that and being trustworthy. It's one of the relatively few institutions around the world that I would trust in that way. But you say you're taking it from the producers. You're offering gold miners an actual way to sell their gold directly?
Yeah, well, obviously what we do is we white label our technology. So we can distribute it to a miner, we could distribute it to a trade house, for instance, right, who wanted to obviously on-sell or fractionalize a commodity that they're originating in the first place. In the instance of the Perth Mint, obviously, they're procuring gold from miners, they're refining that gold and then on-selling it. We offer them the ability to sell that refined product, so effectively a 99.9 assay gold into the market. With other providers, we could obviously license depending on what the actual end user demand would be. For a miner, it's a little bit different because I don't think the opportunity is as great for the investors side of things. I don't think investors would want to take as big a sort of risk on an underlying miner. There's a lot of operational risk that comes with actually extracting the physical metal or whatever it could be, molecules out of the ground, and thus you're taking additional credit risk. With the Perth Mint, obviously you're not taking really that credit risk with, the government guarantee behind the gold. Obviously it's a well-reputable institution. So it depends on who we license the technology to, is how it would obviously be portrayed in the market and what the investor appetite would be. The technology, in essence, to be clear, it can be used for a number of different things in the commodity space. We view ourselves as a commodity digital trade house. And the reason for saying that is, we see it's applicable in the trade finance industry, it's applicable in the repo industry. It's really a way of doing instantaneous payments, elimination of clearing and settlement risk, and moving title. So we can move title between two different producers. We can move cash between two different producers instantaneously and for free.
So does it have its blockchain or is it not?
So in essence, what the the technology we licensed to, for instance, Perth Mint is like a single node blockchain, right? It's a central registry that's cryptographically secured and infinitely fractionable. We do also we have a gateway to the blockchain, the public blockchain on Ethereum. We have a token called the Perth Mint Gold token that is actually backed by our Gold Pass digital certificates. So what that means is users of PMGT on the Ethereum blockchain can buy and sell the token. When they're buying and selling the token, they're buying and selling gold held by the Perth Mint as custodian for the token. They can convert that token into a Gold Pass digital certificate, elect to take physical delivery, sell the gold back to the Perth Mint, transfer it peer-to-peer, or convert it back into a token and trade it back on the public blockchain.
One aspect of the digital ownership that has always confused me is the storage cost, and how over time that is accounted for in these digital tokens, right? So is there some sort of, I guess, incremental reduction in how much each token is worth over time?
Yeah, so for our token, we have no storage costs. So that's not an issue. So generally speaking, though, if you had an allocated product with, meaningful amounts of storage costs, which a lot of the other tokens out there are really, to make it a bit clearer, because they're not licensing technology to the actual provider of the underlying asset, they're really becoming another wrapper, right? And they're wrapping that, putting a smart contract on it and making it available on the blockchain, but they still have all the costs associated with managing that physical asset. Now, there are costs obviously that would be like your either your on-chain fees or your storage fees, as you mentioned. Generally speaking, that's done as some form of decay factor. So the ounces you hold would decay over time to cover the cost of the underlying storage fees. There's other ways you could solve for it. You could have additional tokens that you need to hold, effectively like a utility token, which works as a payment methodology for the storage. But generally speaking, the simplest way is to decay the underlying ownership.
Yeah, but you say that with the Perth Mint, they're not decaying that ownership. It's just a subsidized program, basically.
Yeah, that is. We don't charge any storage fees at all for unallocated gold. So effectively, there's no decay in your token ownership, whether you hold it via PMGT or you hold it via Perth Mint Gold Pass.
Right. Okay. Go ahead, Brian.
Yeah. So the Perth Mint then makes the spread on selling the gold at one time and then stores the metal but doesn't make any more return on it?
That's right, yeah. So the Perth Mint provides all the pricing, everything obviously via the app. It's their pricing. Once they've sold the gold, they'll act as custodian for that gold on behalf of the client. The expectation is the client would generally come back and trade it again, and they could trade through the app, and there's transactional volume in that sort of transaction. However, so to speak, there's no additional fee. So once the client's traded, that's the only fee there is.
Now, what if the Perth Mint decides at some point to institute a fee? Would that be addressable through the software, or is there?
No, you couldn't just add a fee on at a later date. So if you've already bought your gold, the Perth Mint can't come in and say, we're going to charge you, 20 basis points to hold this gold. When you transact, you're effectively trading a smart contract. So that contract is effectively the terms that you're transacting under, and those terms effectively say you're not paying any fees. Sounds
like quite a deal for the investor then.
Yeah, well, I think it's, what we pitched PMGT, so the token as is a institutional disruptor. We're working with some of the largest traditional commodity brokers around the world to target the interbank XAU market for PMGT to replace that market. I believe that over time, tokenization will offer at least a complementary service to some of the existing contracts out there. However, when we get to that sort of evolution of smart contracts, people won't be talking about tokens anymore. They'll just be talking about trading gold. You won't realize that you're transacting a smart contract. Title and settlement will all happen instantaneously. You won't have clearing and settlement risk, and these brokers will be broking them. But yeah, to answer your question, listen, it is a very attractive solution for investors, either via Gold Pass or via PMGT. particularly for long-term holders. So if you're someone who wants to hold gold for 10 years, I mean, to me, it's a much cheaper solution paying a one-off transaction fee than, holding it and paying an annual storage fee, like GLD, which is obviously 40 points a year.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, I'm Brian London, and I'm here at this week's Discovery Group CEO interview. And as you know, the Discovery Group is the sponsor of the Gold Newsletter podcast, and each week we feature an interview with one of the CEOs of one of the Discovery Group companies. This week, I'm very happy to have Brandon Macdonald here with us from Fireweed Zinc, symbol FWZ on the Venture Exchange, because, Brandon, you've just made a exceptional news announcement last week. Still more to come, but you've come a long way in making a zinc lead deposit sexy. And it's happening as we speak. Can you kind of describe the big news you had last week?
Yeah, I guess it started about a month ago. We announced that we had done about a 50 line kilometer gravity survey around the boundary zone, which is the western part of the property. We had a couple of really great drill holes there last year. And this gravity survey kind of showed the core boundary zone, but it showed that it continued, 600, 700, 800 meters at least to the west and a little bit to the east. Now, at that point, it was just kind of a gravity signature. So it's like, okay, there could be another reason why this is a continuous gravity anomaly from the core boundary zone. We felt that was far too much of a coincidence. So we drilled something, quite near the western edge of this anomaly, a very big step out, 400 meters basically from the furthest west drill holes, at the core boundary. And we hit, zinc lead mineralization, a very significant intersection. So, assays are pending. We felt it was important to reveal this to the market to kind of, because with the way labs are this year, we weren't sure about when this was going to get out. So we wanted to make sure that we weren't sitting on this information for 2 or 3 months and that we had disseminated it and, if we need to, can opportunistically finance, et cetera, right?
Yeah, so you characterized it as wide zones of mineralization. And of course you do not have assays back, so you can't really quantify that. But how deep are these holes? And I'm assuming that when you drilled, you did not extend the holes past what you could visually observe as being the mineralized zone.
Yeah, look, you're going to probably give it, 20 meters or so of dead rock before you call it. But the one hole was drilled, I think, 330 meters. Suffice to say, we're not going to go that deep unless we're hitting mineralization. In context, like our holes last year were, they were about 300 meters intersected width of, 3.5 to 4% zinc. So this, when we said significant mineralization, we meant something of that order of magnitude, right?
Yeah.
And, there were some drill holes north of there that were just off the gravity anomaly that 𝗀𝗃𝗀𝗁 drilled a couple decades ago, and 3 decades ago, actually. And there they hit, things like 20 meters of 3% zinc, and then another hole was 10 meters of almost 10% zinc equivalent. We don't consider those significant in terms of boundary zone, in terms of the scale of what that system, puts out. So, that we drilled that deep and that you see historic holes that we consider significant and those we don't, it helps investors kind of clue in as to what magnitude we're talking about. The assays are going to reveal exactly what it is, but we feel comfortable, and we felt comfortable putting out that news release and saying that there was significant mineralization across the hole.
Yeah, and I think investors have taken the hints here and there, and the depth of that hole, and the fact that you're talking about wide mineralization and a broader area on your property position, where you've already demonstrated a resource of some, I guess, 50 million tons of inferred and indicated mineralization, and just the aerial extent, the size of this anomaly at boundary, and the indications that you have wide mineralization in your first holes there. and you're fairly good. I mean, it's fairly indicative. You can pretty much see when you're into stuff that this has the potential to dramatically expand and possibly multiply that identified resource that you already have. The share price has gone up a good bit on this news, hasn't it? And over the past week, 2 weeks, month or so.
Yeah, I think in the last 3-4 weeks we've doubled. There was a little bit to start, just people getting warmed up about drilling, and then we put that news out, and I pre-recorded a video last week for something that was released today, and I was talking about my share price being 85 cents, and today it's $1. I think it closed $1.27 or something like that. So I was a bit out of sync.
Darn, what a problem to have, huh?
Yeah. So look, and now the challenge is management when you reveal that something's hit before you have assays, is that you have to be comfortable that people aren't going to be extremely underwhelmed when you put out those results. And we're not, Discovery Group is not a promotional shop where we're going to run the share price up on some BS and then try to cash out. So management was comfortable doing that. None of us are selling shares. We're eagerly awaiting those assay results.
So the share price has doubled or thereabouts over the last few weeks. Investors would look at that, speculators in this area would look at that and say, oh, darn it, I missed another story if they don't own it already. What can we tell them to try and characterize where you are? I mean, I look at it, my feeling is this is a major buy right now, given the scope of the potential discovery that you have here. And there's much more ahead. But how can we give comfort to investors that think they may have missed the story and give them some idea of the potential scope of the upside from here?
Yeah, I think you got to look at the fact that we're only worth about, I think, 65-ish million Canadian right now.
Mm-hmm.
That was a market cap we hit in 2018 before we even owned the boundary zone, right?
Yeah.
So that was on the back of our 2018 resource and PEA. Since then we've had government funding for the road. We've basically discovered this giant extension of the boundary zone and bought boundary zone, right? So it's just the beginning. And I think the example that I've been using is Arizona mining, which, zinc-led 𝗂𝗵𝘁𝗀𝗄𝗏 project in Arizona sold for 2.1 billion Canadian cash to South 32 in 2018. That was, they had a 30x, like 30 times run up in their share price in the last 2.5 years before that takeout. So 2.1 billion, we're worth a fair bit less than that. Yeah. And I think if we can backfill those drill results and really prove it up, and it is a viable mega sort of pit that we think it could be, then we're going to have closed the gap between us and what the 𝗂𝗵𝘁𝗄𝗏 project was, and potentially command the sort of valuation that Arizona mining did.
Yeah, and I think it's important to note that this was a gravity anomaly discovered. You have a very large property position. You have, even in addition to boundary, other targets, other anomalies. You're fully funded to drill program not only on boundary, which is in progress. Let's remember these results are upcoming, but also other targets. Can you talk about even that, the other targets you're drilling?
Yeah, so we got one more target we're going to drill this year, the 240-mile target. Now that's in between Tom and Jason, which is in the eastern part of the property. So that, it's a structural, geochemical, and gravity target, right? So it has everything kind of in place to be a Tom and Jason style deposit, right? So very excited about that one. Tom and Jason are sort of 10 to 30 meters thick on average, but much higher grade than boundary zone. So that should be, if it's a Tom and Jason style target and hits, it's going to be a narrow intersection, but it could be very juicy, right? So we know Tom and Jason, particularly look at the Tom East zone that gets up to 25% zinc equivalent on average. It could be a very exciting hole if it hits. So we haven't drilled that yet, so we'll see. We should know in a couple weeks.
Well, you certainly have made zinc-lead deposits sexy with this and the potential that you have here. I can't emphasize it enough. Sometimes you invest in a company because you like the idea, and when they prove up that idea and when that idea is validated, then you just have to invest more. A lot of the risk has been taken out of Fireweed zinc at this point because you know you have an enormous target ahead of you. You have the money to drill it. You have assays on the way, and there's just so much more upside to it. So you made a lot of money for our readers in Gold Newsletter, but I think you have much more down the road to do for our readers. And great work so far. We're looking forward to the results. Brandon, thank you so much for visiting with us today.
Yeah, thanks for having me, Brian.
Yeah, when you think about it, it's a lot like a bank. I mean, the Perf Mint already has the vault facilities set up, and a bank doesn't, well, at least not yet, typically charge you rent for your money. Although we're going that direction, it appears, in a number of places, but they make money on the transactions and in the money flowing, and so the bullion flows. I guess that's how they're looking at making the money. What kind of impact do you think this will have, both your product specifically and these kinds of products generally on the global gold market? Is it going to make it more accessible and therefore increase demand?
Yeah, I think that's right. I think we're making gold definitely more accessible right now to the retail market. I think historically gold's always been accessible to the institutional market, generally not accessible to the retail market. A lot of people don't truly understand how an ETF works. Brokers in the security space generally don't understand the gold market, so they don't actively promote it as an underlying investment opportunity. So yeah, I believe we are starting to see that. We've seen exceptional growth, obviously, in our app here in Australia, and we've just launched in the US. I mean, it's up over 100% type user growth in the last 6 months. Assets under management is growing exponentially. So there is this sort of, I guess, inertia behind it from a retail perspective. I think, as I said originally at the start of this podcast, though, the real catalyst for gold is the market participation changing. So not just that retail space, but the institutional space, and probably more likely the investment mandates of the pension funds, superannuation funds around the world saying, you know what, we need to hold gold, we need to hold hard assets, potentially to protect against some form of inflationary environment, secular inflation, etc. And in that sort of step, that will be really a lockstep for gold to move it dramatically higher.
Yeah, the institutional markets, I get the feeling that gold's been very resilient. We haven't had any steep sell-offs after we've had 2 big rallies this year in the post-pandemic environment. And after each rally, we've had a period of sideways consolidation where it seems the metal has consolidated those rallies through time rather than price. We haven't had a significant price correction. Sure, we've come off of some sharp price peaks or spikes, but we haven't had a significant or lasting decline in the price or correction. And I think that's because, at least my feeling is that we're seeing a lot of institutional money just shifting allocations and kind of programmatically buying on dips. And there's just a lot of support out there. It's not coming from the Asian markets, I don't believe, because they're typically don't follow a price up. And it just seems like the mix is getting more and more institutional lately. And that's just a huge well of potential buying for the gold market. The gold market is tiny compared to every other major asset class. And just a shift from a 0 or a fraction of a percent in allocation toward the metal to even 1% of a lot of these funds would be literally overwhelming for the market. Are you seeing some of that through your product? Are you getting toehold into that institutional market now?
We're not. Yes and no. We've started seeing family offices invest in our products. So small family offices, 5 to 10 million type transactions. So I wouldn't say they're big transactions in the gold space, but they are definitely dipping their toe in the water. I think what has been a really positive sign for the gold market more recently in the last, really 10 days, we've seen dollar strength and gold remaining pretty stable. When we sort of generally have this sideways trading activity, dollar strength is met by generally gold weakness, and dollar weakness is met by gold strength. A decoupling of that correlation, I think, will be a very positive thing for gold. Obviously, I personally believe we're going to see significant downside in the dollar going forward. Obviously the US has a lot of social unrest. There's a lot of political divide. Obviously the stimulus we mentioned before and how that could potentially look. But, realistically, if we see the dollar, 10, 20% lower from where it is today, that is also another big mover for gold just in general. So there's correlation to dollar is a driver, correlation to market participants is a driver. And then there's obviously this structural shift towards the asset class as an alternative, coming back to what I mentioned before around, what do we do about this bond market where, we're at zero rates, and is it zero rates for longer? Is it zero rates for 10 years? Are we moving towards MMT where rates are on the floor for an indefinite period of time? I think there's a lot of questions out there, and that's why we're starting to see more and more dollars shift to the space.
And just maybe Brian wants to comment on this too. What will be the future of personal gold holdings? Will physical possession become redundant or just wither away? Yeah, go ahead, Brian.
I don't think, and I don't recommend that happening. I tell people they need to have some measure of physical gold and silver holdings in their physical possession or nearby accessible. But you have to recognize that if you're investing in precious metals as insurance against your wealth, then to get an appreciable amount of insurance, you can't physically hold all of that in your possession. So you have to have some sort of, for a lot of people, for the market we're talking about, that it's not really possible or practical to hold that kind of metal or as much as they would want to own underneath their mattress, as it were, or somewhere accessible, that they need to branch out and have some other storage options, whether it be paper representations or physical bullion storage, whatever. It seems like this product, John's product, is a great solution for that.
Okay, let me get your website there. We've been speaking with Jon Deane, Infinigold, and it's just gold.com. Should we look anywhere else to follow your work? John, do you want to recommend another website while you get the chance?
Yeah, sure. We have, obviously, our token website is pmgt.io. So if you wanted to look into the blockchain solution as well, it's available there.
Okay, and listeners, if you're on YouTube, SoundCloud, wherever, please don't hesitate to respond and give us your feedback. We're eager to get more engagement. Tell us, are you holding digital gold, and do you dispute John's earlier contention that the paper gold is backed? If not, let us know. Otherwise, Jon, thanks for giving your time. Have a great day down under.
Thanks, guys.